So now we're going to talk about a zero interest-bearing note. It's a very common example in most current liabilities chapters, and so we're just going to kind of walk through how to do one very quickly here. All right, so a couple of things just about the zero interest-bearing note. First of all, that zero interest-bearing note does not have a stated rate or a contractual rate of interest. In this case, the lender is going to charge a discount, which basically means that the lender will offer an amount that is less than the face amount of the note, and that discount is that difference between the face amount and what the lender is willing to pay for the note. So why does the lender do this, and what does the discount really capture? So first of all, this is the time value of money at work. In other words, the lender, they're foregoing their cash, even if it's for a short amount of time. It's not free for them to do so. And so because of that, they're going to have to charge interest. And so in the case of a zero interest bearing note, the form of that interest is the discount. It ends up being kind of this implicit interest that's charged. And this is the amount of interest that will accrue over the life of the note. Again, this is the difference between the face amount and the amount of cash that the lender is willing to give the borrower. So as an example, Panther Company issues a $50,000 5-month zero interest-bearing note on December 1st, 2018. 49er Bank purchases the note for $48,500. And in this case, Panther is going to use the straight line method, which is acceptable for short-term notes, for amortizing the discount. So the initial entry, of course, they receive $48,500. The note payable has a face amount of $50,000, and the difference between the two is the discount on the note payable. So the next thing they have to do is at the end of the fiscal year, 1 month later, because time has passed and because there is this implicit interest being charged on the note, the company does have to record interest expense. And in this case, that interest expense is going to be driven by the amortization of the discount on the note. If you recall, we said in the previous slide that they're using the straight line method, which basically means that the $1,500 is amortized evenly over the 5-month life of the note. And so because of that, the amortization for the 1 month that has passed would be 1/5 of the total amount of $1,500 or $300 for the month of December. So we amortize the discount on the note, and from that we infer an interest expense. Then on April 30th, 2019, the note comes due, and a couple things have to happen. Of course, they're going to pay the face amount of the note, and secondly, we do need to amortize the remaining discount, and from that amortization, we will infer an additional interest expense. Again, time has passed, so there's 4 months that have passed. We need to continue to amortize the discount using the straight line method and record the interest expense. And so the amortization for the remaining 4 months, of course, would be $1,200. And so we have the interest expense and the amortization of the discount on the note as $1,200 and the repayment of the note payable as $50,000.